In the end of the last lesson, we were talking about the financial system, the system by which the funds that are available from savers are made available to the firms that might be able to use them for operations and for business expansion. We're going to focus in this particular lesson on the banks within that financial system. Banks are typically depository financial institutions. That is, people deposit their money into the banks. They're intermediary institutions. They stand in between the folks who are doing the savings and the folks who are borrowing that money out to do investment with. Okay? These include banks, credit unions, savings and loan associations, and so forth. The important thing here is that these are depository institutions. People deposit their money into these institutions. So these institutions need to take substantial prudent action while they are lending out their funds in order to be able to preserve the value of the deposits that people have been entrusted to them. Let's take a look at what banks do. Banks take in deposits from savers who want reasonably ready access to their funds. They don't want to be tied up in very long-term assets, but they want access to those funds when they desire. So they can come in and withdraw those funds, or they can write checks on those funds. Those funds are liquid. They're part of M1. The bank also takes in savings deposits that might be part of M2, that is a little bit less liquid. Savings accounts used to be part of M2, but they're now moved up to M1 because they're accessible these days given new technologies. But things like certificates of deposit, where people agree to leave their money on deposit for 3 months or 6 months at a time, those are additional deposits that banks take in. They're not readily checkable, so they're not part of M1. Additionally, the banks may take in funds from other banks. Some banks may have opportunities to make loans to companies that exceed the financial resources of the bank at that moment. That bank can borrow funds from other banks in order to make the larger loans. Those all are liabilities to the bank. The bank has responsibility to pay those things back. On the other side of the balance sheet are the assets. The bank uses to do its business cash that it takes in, and if it's taken the cash in and already lent it out, the loans that it has lent out become assets of the bank. There's a contract there that says that the bank is going to get paid, so it's an asset for the bank. Additionally, if the bank does not have immediate sources for lending out opportunities, then they might decide that they'll take the cash that they have and place it in short-term securities like treasury bills or treasury notes to hold on to the money in some form that generates a little bit of interest while they're waiting for opportunities to lend the money out. And certainly some banks have larger cash balances than they have opportunities for lending at the moment. They may lend their funds to other banks. If they're lending the funds to other banks, it's an asset. They expect to get repaid to this bank. If I have borrowed from another bank, the other bank expects to be repaid. It's a responsibility of mine to repay. That's the loans from other banks being a liability. Additionally, somebody owns this bank, and somebody has some money behind the operation so that the bank could start lending out in the first place. So somebody has an ownership share. That is, as this bank functions, it should be making a bit of profit. It takes money in and pays a little bit of interest. it puts money out and charges a bit more interest, and that difference, called the spread, is where the bank generally makes its money. Now, it has turned out that banks have other opportunities to make money as well. In the process of lending out, okay, the banks may generate a portfolio of loans that it decides, hey, I don't really want to hold on to these loans until they're repaid in 20, 30 years. I want to do the banking thing of making loans. So banks have taken to bundling their loan portfolios together and selling them off as a chunk to other folks who do want to hold longer term assets. The bank gets paid cash and now has more cash to lend out. So this banking process is a way in which banks, being in the middle, take in cash resources from a variety of sources and make those resources available in the forms of loans to folks who need those liquid resources. And they make some money in the process. And the owners are the ones who put up the capital at the beginning of the bank, or they may have sold their shares to someone else, but somebody owns the shares of the bank, and they receive the profits that are generated by the bank providing these intermediary services. Banks don't just make money out of the air, they provide services that are valued by the customers, whether they're the savers or the borrowers, and so the owners make a bit of profit. Now, the problem occasionally comes when the bank winds up at risk of failing. Now, a bank winds up at risk of failing when the assets total is less than the liabilities total. Now, if the assets total is less than the liabilities total, it should first be obvious that owner's equity has to be negative, right? That is, the assets are smaller than the liabilities, so the owner's equity, the owners don't have any equity left. It's all been eaten up in this process of not doing the banking well. Now, those bank failures may occur because the value of the assets shrink, the loans outstanding, when they lent out all of that money, say, to finance mortgages. If the value of the underlying asset, the houses, was to come down substantially as they did in 2008 and 2009, then the bank is holding pieces of paper which say either I'll get paid or I'll own that property. Well, now that property is worth much less than the money that they lent out on that property. The asset value has fallen, and the value of the assets is not enough to cover all those liabilities. Additionally, then it may be that the folks who are depositing money into the bank become very concerned that this bank might not be able to give them their money back. If everyone converges on the bank all at the same time, and wants their cash out of the bank has a problem because the bank doesn't have that much cash, right? The bank is in the business of taking the cash in and making loans out. So the bank has pieces of paper saying, hey, there are loans here that we have made, but we don't have the ready cash to meet all of the demands from the customers at a particular moment. That's called a run on the bank. It doesn't happen often, but occasionally it will. One of the big problems that banks face is that the depositors can ask for their money at any time, but the bank, having lent the money out in the form of, say, a mortgage, can't necessarily demand that the mortgage all be paid all at once. That wasn't the terms of the contract. Though technically they're occasionally written into those contracts. Yes, the bank could demand the repayment, but they're really pretty ineffectual because the whole reason that people took the loan out was that they didn't have the cash at the time, right? So bank management is an important function, but it's also a somewhat risky function. Owners make a certain amount of return on their investment, but there is some risk that the banks might fail altogether. Now, let's talk about money as in M1 when the banks get involved. Okay? Let's consider an opportunity where the bank takes in a deposit, say $1,000. They take in the deposit, and that becomes cash in the bank with a checkable deposit. Now, as long as the cash stays in the bank, the only part of M1 is the checkable deposit. Cash in the bank is not readily transactable. But remember, the bank is a financial intermediary. Their job is to lend that money back out. So they make a loan out, they create a loan contract, and the cash goes back out. Now, careful. Notice what just happened. There's a checkable deposit for $1,000, but now if the bank loans that money back out, there's now cash in circulation again as another $1,000. So there's actually now $2,000 in cash, in money in this economy. But when the loan gets paid out, then somebody who borrows the money uses that money for either an investment or for purchasing a car or other forms of consumption. And the folks who sold the goods then take the money in and take it to their bank and deposit it. So there's an additional checkable deposit. Okay? But the cash is back in the vault. Okay? But then the cash can be lent out again, and now it's 3 times the amount of the original deposit that's part of M1. So there's this money creation, the expansion of the money supply, because the banks take in the cash resource and then lend it back out while still giving the original depositor the ability to withdraw some of it or to use it as a checkable balance. Now, the whole trick here, of course, is that the banks don't lend out 100% of all of the money, because then there would be no money for the transactions to be occurring. Or somebody comes in and says, I want to withdraw my cash. There's no cash in the vault to give them. So the banks keep a fraction of the cash that gets deposited so that they have the ability to give their money back to whatever depositor wants their money back on a particular day. They keep a small fraction of the cash, but banks make money by charging interest on lending the money out. The more money they lend out, the more interest they receive on that money, and the greater the return to operating the bank. But the less money in the vault, the more risk that there will be a lot of people coming in to say, I want my money. And if you say no, then that influences everybody's opinions, and your bank doesn't get any customers after that. So the banks hold on to a fraction of the cash, but the rest of it being lent out and then put back in the banking system, lent out again and coming back into the banking system somewhere, and then lent out again and coming back in over and over and over again, that all adds to the total amount of M1 outstanding. So if the process of money creation by the bank is clear, that is, it happens because the bank is able to lend the money out, take deposits back in, lend the same money out, take deposits in again, lend the money out again. It creates the liquidity for more than just the original depositor. Question, where does the initial deposit, the initial money come from that comes into the bank? Well, this is where the Federal Reserve becomes important. The Federal Reserve is in charge of managing the money supply for the United States. Okay? And the Federal Reserve accomplishes their work by going out and purchasing other assets, in particular usually treasury bills and treasury notes. Okay? By purchasing those other assets and bringing the less liquid assets in, they exchange it for more liquid cash. Now, this is money creation when the Federal Reserve does it, because the Federal Reserve doesn't have to have gotten the cash from anywhere else. They're able to, well, if it was done in paper currency issue, the Federal Reserve would be printing the paper and issuing it. Well, it's now done by electronic balance transfer, but the same principle applies. It goes into the accounts of the people who sell those treasury securities to the Federal Reserve and becomes additional deposits in the bank. The bank can then lend out the money because it's additional deposits of cash, of liquid resources. They can lend it out and multiply the money again. So when the Fed undertakes monetary policy, and we'll be talking about monetary policy next, when the Fed either expands the money supply or contracts the money supply, they do so by buying in government bonds, which puts cash out into the system, or by selling some of the government bonds that they hold and taking cash in out of the system. They can expand or contract the money supply. But don't forget that the amount of money that gets created is not just the injection from the Federal Reserve, but the Federal Reserve putting cash into the deposits in the bank for the folks who sold them the less liquid treasury bills and bonds. Those deposits are now available for the banks to multiply. Okay? So the initial injection by the Federal Reserve gets multiplied. The money supply expands by more than what the Fed put in. So managing the money supply is a rather complicated process because the Federal Reserve has to know fairly closely how much multiplication is going to happen when they put money into the system. They don't want to put $10 million into the system and have it suddenly become $200 million because of the multiplication, if their intent was simply to put $10 million into the system. They need to know what that multiplier is so that they can do the monetary policy correctly. So if you kind of want to think about the spending cycle going on in the economy, well, I spend money on the refrigerator. The refrigerator producers then take that income in, and they have that income available. Well, part of it obviously goes to their suppliers and their workers, and their workers have now more income, so they can go out and spend their money on things that they want to buy. And that becomes income to the folks who are producing those goods. And then, yeah, and you get it? It keeps going around and around and around. Except that not every dollar goes all the way around every time. Some leaks off into savings. Okay. And then the rest of it goes around. So that additional amount is smaller and smaller as it goes around, which is why we get to a number instead of, an extra dollar of spending becomes an infinite amount of money for people to take in as income and spend off. No, not at all. But some of it is still available for additional spending, additional income, and then spending beyond that. That's the multiplier. Some leaks out as savings, but there may be other leakages as well. Now remember, as income comes in, you put some away for savings, And you put some away because you're going to have to pay taxes on the income. It's income taxes. And that means that that amount is also not available to go out in spending. So there's another leakage. Right? But then additional, remember C plus I plus G plus X minus M. Well, if we start spending more on imports, that's a reduction in the money that stays available within our country to expand the cycle here. Now, let me emphasize, it does go into the other countries' resources because for them, what we are importing, they exported. So their exports go up. So now there's more money in their economy to expand their economy as well. But for us, that increase in imports would be another one of those leakages out. So the total multiplier effect within our economy depends on how much of the dollar each time that it goes around the cycle, how much of it leaks out and doesn't become additional spending. It may leak out on savings, it may leak out on taxes, it may leak out on import purchases. Now, the money multiplier is not the same thing as the output multiplier. They are somewhat related because the money then becomes available for lending, which becomes available for an expansion of I, which then becomes available to be multiplied as a part of the GDP. That is, it's income that goes to creating new value, that goes to income, that goes to creating new value. What we're talking about here is the money multiplier. And instead of the multiplication happening in the production end of the economy, the money multiplier happens in the banking end of the economy. And so when the money comes into the bank and becomes part of the deposits for the bank reserves some of that money, and that's a leakage out of the money that's then available to be lent out to come back in, to be lent out to come back in. The circular process is similar, but make sure you distinguish between the GDP output multiplier, again, which has to do with the productive cycle of value in the economy, and the money multiplier, which has to do with the increase in liquidity through the banking system. Now, remember that circular flow diagram? The circular flow diagram had the productive part, the real part of the economy, and the money part, the liquidity part of the economy. So when the Federal Reserve is setting monetary policy, they're going to need to know what this money multiplier is when they inject new funds into the economy. They do so by increasing the deposit balances of the people who sell to the Fed those government securities. That expanded deposit becomes available for the banks to lend out, that comes back in, to lend out. So it's critical that the Fed understands how large this money multiplier is when they think about how much they want to expand the money supply. Okay, that money multiplier is simply calculated as 1 divided by the reserve ratio, where the reserve ratio is that percentage that the banks hold in reserve, lending out the rest each time the money goes out and comes back in. So the 1 divided by the reserve ratio is the way that we calculate the total expansion of the money supply. Okay? For instance, if there's $1,000 deposit and the banks hold 12% or 0.12, the banks hold 12% in reserve, they can then lend out of the $1,000 deposit an additional amount of money, which then comes back in, then goes back out. But when every time it comes in, we hold another 12% in, it goes back out, comes in, we hold another 12%. The total winds up being, the total expanded money winds up being 8,333 because this reserve ratio of 12%, well, we can just perform this calculation using this money multiplier, right? So we multiply the initial deposit of $1,000 by this ratio, the 1 divided by 0.12, and that multiplies up. Remember, since you're dividing by a smaller number than 1, the total's going to be bigger, so that money multiplier turns out to be 8.33. So $1,000 deposit times 8.33, $8,333 is the expansion of the money supply. Now, it's also true, as with the cycle over on the production side that led to the output multiplier, it's also true that there are other places in which money leaks out when we're talking about this liquidity cycle. And over here, those additional leakages really are when people don't just deposit the money back in the bank, but they hold more money in their pockets. If they hold more money in the pockets, it doesn't go back into the bank in order to continue to be multiplied. So we'd have to increase the leakage number from the reserve ratio to include the reserve ratio and the percentage that people hold as they hold it in their pockets instead of redepositing. But the idea is similar to that output multiplier for GDP. Just keep them straight. They are two different things going on. One additional concept in this discussion about money and people's relationship with money and thinking about what the opportunities are for them when they hold money, we call it the time value of money. And most easily it's can be seen through an example such as, would you rather have $1,000 today or $1,000 if I give it to you 1 year from now? Most people would rather have the $1,000 today. They would think, well, I could at worst take that $1,000 and just hold on to it, and in a year I'll still have $1,000. So I can get the $1,000 a year from now if I take the $1,000 today and just hold it. Or I can take the $1,000 today and do other things with it too. So having the $1,000 today gives people more options, more opportunities than waiting for it. So most people would prefer to have the $1,000 now. In fact, in some cases, we can run the experiment which says, would you rather have $800 today or $1,000 a year from now? That experiment shows us that there's the value of money not only depends on how many dollars, but on when those dollars would be received. And in fact, if you offer someone $1,000 today, they might, or $1,000 a year from now, they might put a value on that $1,000 a year from now that's somewhat less, maybe $800, maybe $600. Whatever that number is, the idea of time value of money is closely associated with the idea that you have more alternatives and more options if you have the money today, so money in the future is worth something less to you. Now, to be clear, we're not talking about how much money you could have if you took that $1,000 and invested it and got interest. We're not talking about there maybe being inflation. Those things are also part of the way that we think about the value of having money today. But the whole focus here is the simple fact that most people would choose the $1,000 today and think that the $1,000 in the future is worth less to them if they had to make the the evaluation today. So it might be $800 today or 1,000. Yeah, I'm kind of even on that. Or 600 or 1,000. Not because there's some interest amount that they could receive, though that would be one option or alternative, but because most fundamentally they really would just rather have the money in their hands right now.